if you have no issue with all these practice, you should be able to do your quiz question from the first technical assignment as well. Okay? So read the question carefully, especially pay attention to the date of transaction, pay attention to the requirements in the question. Okay? All right, now, so that is your class quiz, okay, from the first technical assignment. Now let's move on to have a look at the topic we are going to discuss today. So last week we have focused our discussion on consolidation, right? We start the consolidation process from the last week, from the last session, not last week. Now, in the previous session, we learned how to prepare the worksheet entries on acquisition day and subsequent to the acquisition day, and focus on only the first two type of adjustment in the worksheet. So namely the fair value revaluation entries on consolidation, and what the other one are pre-acquisition entries. Okay. So these two type of adjustments are required in your consolidation worksheet. Now, in addition to these adjustments, we also need to prepare the elimination entries to remove the effect of the intragroup transaction. Now, this is the third type of adjustment we are going to discuss in topic 4. Now, so in topic 3, the group under discussion is a wholly owned subsidiary. There's only one parent, of course, only one parent in any group, and there's only one subsidiary as well. And the parent's ownership interest in the subsidiary is 100%. So that's what we call a wholly owned subsidiary. Now, the group under discussion in our topic today, again, same. Okay, so we are going to introduce the NCI in the next week topic. All right, so you can see we're going to continue our discussion of ASB 10. So that is a consolidated financial statement. Now, first question you want to ask, what is intragroup transaction? So what is intragroup transaction, right? So that is a transaction between the entity in the group. So it could be sale from the parents to subsidiary or from subsidiary to the parents. So once again, the group under discussion at this stage only involve one subsidiary, and that is a wholly owned subsidiary entity. Now, when there is a transaction took place between the entity in the same group, now each separate legal entity in the group record such transaction in their accounts. So for example, if the parent's company sell inventory to subsidiary, what is the parent's record in its accounts? There is a debit of, let's assume it's a cash sale, okay? So there'll be a debit of cash, credit, sales revenue, what else? Debit, cost of goods sold, right? And the credit, inventory. So you can see the sales revenue, the cost of goods sold will be included in the parent's record. Now, at the same time, the subsidiary recognizes the purchase of inventory by debit inventory and the credit cash. Well, from the group perspective, these transactions do not exist, right? Because this happened between the entity in the same group. Now, the consolidated financial information should only reflect the transaction with party outside the economic entity. When there is no external party involved in this transaction, it is an intragroup transaction. And the effects of such an intragroup transaction require to be eliminated on the consolidation worksheet, because the group financial performance position should only reflect the transaction and events dealing with a party outside of the group. Now, if you don't prepare the elimination entry, what happened? Well, the effect of the intragroup transaction will be included in the combined figure. When you start your consolidation process, we should adding together, or say combining, the parent's information with all its controlled subsidiary. Any intragroup transaction will be included in this combined figure, right? If you don't provide any elimination entries, that will happen. And this is actually against the purpose of consolidated financial statement. So the purpose of this statement is to show the transaction between dealing with a party outside of the group. Okay? Now we understand what is the intragroup transaction. We understand why the preparation of the elimination entries required on the worksheet. Okay? Now let's look at the rules principles specified in ASB 10. Now ASB 10 requires full adjustment, which means all the intragroup asset, liability, revenue, expense must be eliminated in full in the consolidation worksheet. All the intragroup asset, liability, revenue, expense, equity must be eliminated in full in your consolidation worksheet. Now you can see the ownership interest of the parents in the subsidiary does not matter, which means regardless of the parent's ownership interest, it doesn't matter, it's 100%, 90%, 80%, you don't worry about that. Apply the same principle, full elimination is required. Now you can see an exception is the dividend declared paid by subsidiary. Now why dividends? We have a different rules. It's actually still same rules. Now if assuming a subsidiary, they pay 10,000 dividend, okay? If parent interest is 100%, then the amount of dividend income recognized by the parent would be 10,000, right? Because all the dividend paid by subsidiary received by the parents. If the parent's interest is 100%, the parents recognize dividend income, which is 10,000. Okay? Now, if the parent's interest, let's say 80%, then the dividend income recognized by the parents would be only 8,000. So you can see the intragroup dividend recognized by the parent's company, right, paid by subsidiary, recognized by the parents, it actually depends on the parent entity's ownership interest in subsidiary. Right. So if parents own all the shares, then all the dividend income paid by subsidiary will be recognized by the parents as a dividend income. If parents only own 80%, then the dividend income recorded by parents paid by subsidiary will be 80% of 10,000, which is 8,000. So you can see this is still consistent with our full elimination requirements, right? Because the intragroup dividend income recognized in the parent's record is actually depends on the parent's ownership interest in the subsidiary entity. But for all the other intragroup transactions, for example, intragroup transfer inventory, intragroup transfer PPE, or intragroup services, or intragroup borrowings, you don't need to worry about parents' ownership interest in subsidiary. Okay, that does not matter. Okay, all right. Now, so you can see adjustment will also be required in future period. Of course, that is still depends on. So if the intragroup transfer item has a continuing effect on the following year consolidated accounts, then you need to prepare the adjustment in the future period as well. So for example, in the current year, parents sold equipment to subsidiary, right? Now this equipment is still within the group in the future period. Then you have to continue making the adjustment of these transfer items in the future consolidated accounts. So we're going to show you examples of how to prepare the adjusting entry in the worksheet for more than 1 year. Okay? All right, now so let's look at the purpose or the reason for the elimination. So you can see we have to prepare consolidated financial statement, but another very important reason is to avoid double counting. Now, why there is a double counting? For example, if the parent's company sell the inventory to subsidiary, let's say 10,000, okay? Now the original cost, let's assume is 8,000. Now then the subsidiary pay for 10,000 to acquire this inventory from the parents, right? And sell this inventory to outside party for 15,000. So you can see there's a double counting, right? Because the same inventory, first of all, recognize sales revenue by parents when parents sell to subsidiary, right? And then record sales revenue again by the subsidiary when subsidiary sells this inventory to the party outside the group. Now for the same inventory, you record sales revenue 2 times. That is double counting, right? Similarly, cost of goods sold. When parents sell the inventory, subsidiary record cost of sale. When subsidiary sells this to outside party, again, recognize the cost of sale. So there's a double counting here, okay? Now, so to avoid double counting, it is necessary to remove the effect of the intragroup transaction in your consolidation worksheet. So once again, full elimination is required, okay? So it doesn't matter whether parents own 100%, 70%, or 80% of the subsidiary. Now, the only thing you have to be careful is with dividend. Okay. Now, if there is any intragroup payable, receivable. If the sale is made on the credit, then parent's company will record the receivable, subsidiary recognize accounts payable. Now, all these intragroup asset liability must be eliminated as well. So this is, again, consistent with the full elimination principles. Okay? We have to eliminate in full all the intragroup asset liability revenue expense equity in your consolidation worksheet, as if those intragroup transactions had never occurred. Okay? All right, now let's look at the following MCQ question. Bess? So let me know if you have your answer, okay? So which one is right? The last one, Lanxing. You also choose D. Okay, so I think two of you get the same answer, most likely is the right one, right? Now, so the elimination in full on consolidation. So that is the underlying principles we have to comply according to ASB 10. Okay, full elimination. Very good. All right, now let's look at the intragroup transaction may result in unrealized profit. So we need to, first of all, identify what is unrealized profit and when these profit loss will be realized. Okay. Now the unrealized profit means the profit resulting from the intragroup transaction, well, remain unrealized, but when it is remain unrealized, when the intragroup transfer item is still within the group. For example, when parent company sells inventory to subsidiary, now assuming the selling price, the intragroup selling price, let's assume is 10,000. Okay? So intragroup transfer price, let's assume it is 10,000. Now the original cost to the group, let's assume it is 8,000. Now when parent company sell this inventory to subsidiary for 10,000, and the original cost to the parents is 8,000, so you can see there is a sales revenue, 10,000 is recognized by the parents, and also a cost of goods sold for 8,000, right? Now, using 10,000 minus 8,000, there's 2,000 profit from this intragroup sale. There's 2,000 profit. Are these profits realized? Well, if the inventory is still within the group, these 2,000 remains unrealized. When it will become realized? It is realized when the assets are sold outside the economic entity or consumed. So for PPE, usually it's through the use of the item. And for inventory, when there is third party involved in the transaction, the unrealized profit will become realized from the group viewpoint. So whether it is unrealized is from the group perspective. As long as the image is still within the group, the profit and loss from the intragroup transfer item remains unrealized. Once this item is sold to the outside party or is consumed within the group, then by the legal entity, then the unrealized profit will become realized. Okay? Now, so you can see after adjustment, so account balance in the consolidated financial statement are based on the amounts they would have been if the transaction never occurred. So you can see, again, the purpose of preparing this elimination entry is to remove the effect of this intragroup transaction, right? Now, if there's an intragroup sale of inventory occurs, so you can see the carrying amount of the inventory in your consolidated financial statements is equal to the original cost. So if I ask you what is the inventory balance that should be shown in the consolidated balance sheet, in our example here, that would be 8,000, right? Well, in the record of the legal entity, that is 10,000. So adjustment will be necessary in the worksheet to reduce the carrying amount, right? From 10,000 that is in the record legal entity down to 8,000 that should be reported by the group. Okay. Now, if there is an intragroup sale of the PPE, then the carrying amount of the plant in the consolidated balance sheet is the original cost to the economic entity minus any accumulated depreciation calculated based on the original cost. not the intragroup transferring price. Right? So we're going to use an example to show you how to make these adjustments. But we first of all have to understand the rationale behind the adjustments, understand the general principle and the rules. Okay. All right, now let's look at the next MCQ. The profit on an intragroup business transaction is realized. When it will be realized? When there is an involvement with an external party. So C is the correct answer. Very good. So once this item is sold to the outside party, or if it's a PPE, once this item is used, right, then the unrealized profit and loss will become realized. So C is the right answer here. So let me know if you have any question. Now, we also have to consider the tax effect entry. So must account for tax effect of your adjustment. So why we need to adjust for the tax? Let's have a look at this. Now, when profit loss remains unrealized from the group perspective, you need to eliminate this unrealized profit loss in your consolidated accounts, right? So in your consolidation worksheet. So what is the effect of these adjustments? When you eliminate the unrealized profit, for example, the group profit will be reduced, right? When the group profit decreases, the income tax expense of the group should also decrease. Now here we need to understand each legal entity in the group, they pay their own tax. So parent, subsidiary, they are separate legal entity, right? They pay their own tax. The tax is not paid based on the group level. The tax is paid by each individual entity in the group. Yeah. Now, when parent company, go back to this example, when parent company say sell the inventory to subsidiary, right, and recognize 2,000 profit in its accounts, does parent pay the tax for that 2,000 profit earned in that year? Yes, right? However, from group viewpoint, do you need to pay tax for that profit? No, because it remain unrealized, right? So from group viewpoint, we don't need to pay that 2,000 tax on that 2,000 profit, but parent's company already paid the tax. So what happened? From the group viewpoint, there is a prepaid tax, right? That is already paid by, or will be paid by the parents for that year. So there's prepaid tax. So therefore, a deferred tax asset should be recognized from the group viewpoint. Now let's use an alternative way to explain that. Now, when this inventory is recognized by the buyer, because it's a sale from parent, right, to subsidiary. So what is the subsidiary recall? Subsidiary recall the inventory, say debit inventory for 10,000, because that is how much subsidiary pay, right, to acquire that. So then credit cash, say 10,000. Now remember that they are subsidiary parents, they are two separate legal entities, okay? So let's look at subsidiary. Now, when subsidiary acquire this inventory from the parents and pay 10,000, now what, can you tell me what is the tax base of the inventory? 10,000, that's right. What is the carrying amount? 10,000. So there is no temporary differences at all, right? But we know this inventory from the group viewpoint is overstated by 2,000. So included in your consolidation worksheet, you need to credit inventory by 2,000 because the group have to show the original cost, which is 8,000. So the consolidation balance sheet shows the carrying amount of the inventory is 8,000. Well, the tax base remains same, right? The tax base still 10,000. The tax base won't be affected by your accounting adjustment. The tax base remain as 10,000. Now you got carrying amount 8,000 after adjustment in the worksheet, right? You got tax base 10,000. Well, the difference is your deductible temporary differences because carrying amount is lower, right? So there's a 2,000 deductible temporary differences resulting from these adjustments. Deductible temporary differences leads to recognition of DTA. Okay. So there are two different ways to explain why there's a recognition of a DTA when the unrealized profit from the intragroup transfer item is eliminated, right? So once it's eliminated in your worksheet, the unrealized profit, then you have to show the tax effect entry. But not all the intragroup transactions, require tax effect entries. We will show you which type of the intragroup transaction resulting a tax effect adjustment, and what are those intragroup transactions we don't need to have any tax effect entries here. Okay. All right, now let's start with the transfer of the inventory. Okay. Now, so the elimination entries required to eliminate all the intragroup sales revenue, cost of goods sold, and in addition to that, we need to adjusting the carry amount inventory, right? Because the transferring price is either above, which is very common, or might be below the original cost. So any profit or loss from these intragroup transfer inventory must be eliminated, right? So if it's remain unrealized, it must be eliminated for consolidation purpose. Yeah. And the profit loss it will be realized, right, when the asset is sold to a third party, or these assets used for inventory will be sold to the outside party. Okay. Now, adjust for the tax effect is required if the elimination if the elimination resulting in elimination of the unrealized profit loss from this intragroup transfer inventory. And always remember to show your tax effect adjustment if there's any unrealized profit loss, if there's any profit that remains unrealized from the group viewpoint at the end of the reporting period. Okay? And the adjustment of the carrying amount of the inventory, which is still on hand, right, at the end of the period, these create temporary differences and leads to the recognition of deferred tax. Now, so in the year of the sale, that is in the year when this intragroup transfer inventory took place, we are going to say have a debit sales against credit cost of sale. And for the inventory still on hand, we have an unrealized profit contained in closing balance of the inventory. Now, how to find out the unrealized profit in closing inventory? Now, we can always use a very simple equation. Profit from the intragroup sale multiplied by the percentage of inventory still on hand. Now, profit from the intragroup sale, we just compare transferring price with the original cost, right? So once we identify the profit or loss from the intragroup sales, well, here the adjustment is on the credit, then it should be a profit, right? Transferring price is greater than original cost, so the difference representing the profit from the intragroup sale. Then we multiply by the percentage of inventory which is still on hand. If it's 30%, you multiply 30%. If 20%, multiply 20%. Okay? Now, we usually combine these two entries. We don't record separate entries. So because this topic will be examined in your second technical assignment, right? I'll just let you know, I will only give you 3 lines. Okay? If it's a question required, like an algorithm question required to fill out the journal entry, right? I will only give you 3 lines. So always remember to combine these 2 lines here, okay? All right, now, so you can prepare 2 separate entries if you want to, if the question asks you to write down the journal entry, but when we do a quiz question online, so considering I only give you 3 lines, remember to combine these 2. All right, now let's look at the following example. Now, we are assuming the subsidiary entity acquire inventory from the party outside of the group, from external entity, and paid 100. Now, these 100 also represent the original cost of the inventory to the group, right? Now, then subsidiary sell this inventory to the parent company for price of 150. Now, this is the intragroup transferring price. Now, transaction took place on 25th June 22, and which is current year, as the current year ended on 30 June 22. Okay. Now, we are assuming all inventory still held by the parent entity at the end of the current year. Now, you can see the intragroup profit from the sale is 50, right? Using 150 minus 100, that is included in the recall of subsidiary. There is a 50 profit from this intragroup transaction. And all these profit remains unrealized by the end of the current year because all these inventory, they are still on hand. Okay. Now, in order to find out the worksheet adjustment, let's have a look at the entries recorded by each legal entity. So you can see subsidiary as a seller, right? Record sales revenue, 150. And a cost of goods sold will be debited in subsidiaries record as 100. Okay. Now, sales minus cost of goods sold. So you can see included in the subsidiaries record, there is a profit, right? There is a profit earned from these intragroup transfer item. Now, these 50 profit remains unrealized because all these inventory, they are still on hand. Now, profit of 50 will be realized once the inventory is sold to the external party, but at this stage remains unrealized. Now, then the parent company record inventory value of 150 because that is the amount the parents pay to acquire this inventory. Now, the inventory in the parent entity's balance sheet is 150. However, from the group viewpoint, it is 100. So you can see the legal entity's record of the inventory is overstated compared to the group. And we need to adjust the caramel inventory down by 50, right? So using 150 transferring price minus original cost 100. The inventory on hand, that is 100%, right? So adjustment of inventory will be 50. Okay. Now let's look at the entries recorded by each legal entity here. Now, subsidiary, first of all, acquire the inventory from party outside the group. Now, you don't need to worry about these accounts payable because this is the amount you need to pay to the external entity, right? We don't worry about that. Now, then move on to 25th of June. Now, this is an intragroup transaction. The sales revenue recognized in the book of the subsidiary. Now, these represent intragroup sales revenue. The cost of goods sold and also intragroup expense, right? That they recognize the inventory. Well, this tax entry is not actually required. Okay, so you don't practically prepare this entry after each sales transaction. We don't do that. Okay, we don't do that. Now, why include this is to show you the impact of these transactions on the subsidiaries tax. Okay, so the year-end tax worksheet, including the current tax worksheet, deferred tax worksheet, will capture all the P&L related income tax. So we already learned that from our topic 1, right? So the year-end current tax worksheet will capture all the P&L tax related to the current component. So you don't actually need to record these after each sales transaction. We don't do that, okay? I just show you that this profit is taxable to subsidiary, right? From subsidiary perspective, subsidiary will pay these 15 tax. However, from the group viewpoint, such tax expense do not exist, right? Because the profit from the group viewpoint, this profit is remain unrealized. Now then move on to look at parents record. Debit inventory, credit cash. That's very simple, straightforward. Now what need to be eliminated here? Now highlight this line, sales, credit sales, because that is the intragroup sales revenue, okay? You also need to eliminate cost of goods sold because it's intragroup expense, right? The recognition of this expense is from the intragroup transaction. Okay. What else? Inventory, right? The inventory carry amount is overstated compared to the group. We need to adjust its carry amount from 150 down to 100. So the difference, 50, is included in your worksheet adjustment. Okay. All right, now based on this analysis, let's have a look at our worksheet entries. So you can see the first line is to eliminate all the intragroup sales revenue in full. Well, it doesn't matter whether the parents, whether this inventory is sold, partly sold, or completely sold, doesn't matter, right? All the intragroup sales revenue must be eliminated in full elimination. So we debit sales 150. Now this information usually will be given to you directly, so it's relatively determinable, right? Now then we move on to look at inventory adjustment. So that is a 50 because the profit, right, from the intragroup sale 50 multiplied by the percentage inventory on hand is 100%. So the unrealized profit contained in closing balance inventory, that will be 50. Now the balancing figure that is 100, right? We credit cost of sale. Now we can always use these methods to identify your worksheet adjustment related to the current year, that is related to the current year intergroup transfer inventory. So you can see from the group viewpoint, there is no sales, no cost of sale, and therefore no profit, right? And these profits then need to be eliminated in full in your consolidation worksheet. The impact of this elimination entry, you can see the group profit reduced by 50, right? The group profit reduced by 15. Now, in addition to that, the inventory carry amount should be reduced by 50 because it is original cost 100 that should be shown in your consolidated balance sheet. What's the next? Tax, right? Don't forget tax. So you can see now the profit, unrealized profit 50 is eliminated. Profit decrease, tax decrease. So your income tax expense 15 should be reduced, right? Because the group profit reduced, the income tax expense of the group should also decrease. You don't need to worry about CTL, that is a current tax liability, because the group doesn't pay tax. It is each legal entity, separate legal entity, pay their own tax. Yeah. So the adjustment is made to reduce the group income tax expense due to the elimination of the unrealized profit in the worksheet, reduce the group profit, then reduce income tax expense of the group. On the debit side, we recognize DTA, as we explained previously. So you can see subsidiary will pay the tax, which from the group viewpoint, these unrealized profit do not subject to any tax in the current year. So, but subsidiary will pay the tax, then this leads to the recognition of DTA from the group perspective. Now, alternatively, we can look at the carry amount adjustment for the inventory. So inventory carry amount is 50 lower than its tax base, right? It's length tax base. So because carry amount is lower than tax base by 50, these create deductible temporary differences, which leads to the recognition of the DTA. Okay. All right, now any question? Is there any question? Let me know. So in the first scenario, we are assuming all the inventory is still on hand, right? But what if part of this inventory is sold? Let's look at the next scenario. Now we are assuming this condition same as before. So subsidiary acquire 100 inventory from an external entity and then sells to parents for 150. Now parents then sells 40% of inventory for 100 to external party. Okay. Now let's look at the entries recorded by each legal entity first. Now these are same, right? Same as before. These ones are also same. But in addition to that, parents recognize the sales revenue by selling 40% of the inventory to an external party. Do I need to worry about these sales? I don't, right? So do you need to adjust these sales in the worksheet? You don't, because it is a sales revenue from the group viewpoint. So these sales should be included in your consolidated accounts. So we don't need to make adjustment of these sales. Now then look at the cost of sale. Look at cost of sale. So what is the cost of sale from the group perspective? So think about the cost of sale from the group viewpoint. 60. Is that 60? The 60 is recorded by legal entity. So I would suggest you to draw a table and do some further analysis, because this situation is a bit more complicated compared to the previous one, right? So I will write down sales, because these are the accounts I need to adjust later, right? Cost of sale. What else? Of inventory. Okay. And then this is legal entities record. Now, legal entity here including both parent and subsidiary. Okay? And this is the amount should be reported by the group. The difference represents our adjustment. Okay. Now let's start with the sales. What is the total sales recorded by the legal entity for this inventory? There, 150 plus 100, right? Your consolidation start with combining line by line all the parents' information with its controlled subsidiary. So you can see legal entities record all the sales in relation to this inventory, right? That is 150 plus 100. Okay. So 150 plus 100, that is 250. Now, what is the amount of sales that should be reported by the group? 100. Because that is the sale you make to the external party. Then what is your adjustment? 150. And on the debit or credit? Debit. Okay. So you can see the difference represent your adjustment, and this 150 is actually related to the intra-group sales revenue. Right, so this is consistent with the principal rules we explained earlier. All the intra-group sales revenue must be eliminated in full. So your first line adjustment is to debit sales by 150. Okay. Now then move on to cost of sale. So what is the total cost of sale? 100 here, right? In the record of subsidiary plus 60 record by parent. So it's 160. So what is the amount of cost of sale that should be reported by the group? 60. Take a second thought. What is the original cost of this item to the group? 100. So percentage inventory sold, 40%. Right? So you can see the group, from the group viewpoint, the inventory cost, arrangement cost, is 100. 40% were sold. Therefore, the group should report 40% times 100. The cost of goods sold of 40. The total cost of goods sold recorded by legal entity 160 minus 40. Adjustment is 120. Debit or credit? Debit or credit? Credit. Because this is all debit, right? This is all on the debit side. So then you get a credit here, then 160 minus 120, you get 140. Okay? So just make sure we always keep in mind for the asset liability, revenue expense, whether the balance is on the credit or debit. Okay? Now, finally, inventory. So what is the inventory in the legal entities record? So how to determine inventory? That is, we don't look at here, right? The inventory has been derecognized. It's starting from here. 150 minus 60, right? So 150 minus 60, which is 90. What is the inventory that should be reported by the group? What is the amount of inventory reported by the group? You have 100, right? Multiplied by 60% on hand, which is equal to 60. So 90 minus 60, adjustment is 30 on the credit side, because you have to reduce inventory carrying amount here, right? Then any other, so any question from this analysis, please let me know. Okay. Now, based on this part, we can find out your worksheet adjustment entry, right? So you debit sales, say debit sales 150, right? You credit inventory 30, inventory credit 30, right? Combine these two lines, you have a credit cost of sale of 120. But there's only one problem with these methods. It's a bit time consuming, isn't it? Right? So I do expect you to complete this part like within 2 minutes, but processing all these may take you for more than 2 minutes. So what are we going to do? Let's introduce you the alternative methods. Okay. I'll show you alternative methods in notes. Is actually on Moodle. So I have that for you already on Moodle. So you can just open that from your side as well. Okay. So just scrolling down to week 2, right? Week 2, here we go. So there's a documents, class notes, right? Class notes, click that. Here we go. So you got, The slice number may be wrong, but yeah, you can find that. So you got intragroup current year, intragroup transfer inventory. So this method can be used based on this condition here, okay? So we here have to make several assumptions. So this intragroup transfer occurred in the current year and assuming the transferring price is greater than original cost. Now that is very common, transfer price greater than original cost, but not always the case. So when you read through the question you have in your quiz or exam, so always pay attention whether it is greater or lower than the original cost, because tell you a different story. Now the first step is to eliminate all the intragroup sales revenue in full, not regardless whether the inventory is partly sold or completely sold or remain unsold, doesn't matter. So debit, sales, and this information 150 is readily available, right? Now then moving on to step 2 is to adjust carry amount of inventory. So the inventory of the 30 should be adjusted here based on the profit from the intragroup sale. The profit is equal to intragroup selling price minus the original cost, okay? And then multiply by percentage inventory on hand, because these represent the unrealized profit contained in closing balance of the inventory. Okay? So we use profit from the intragroup sale multiplied by the percentage of inventory still on hand. So if it's 100%, you get a number here, right? If it's 30%, you multiply 30%. And here, in our case, is 60% still on hand, right? So then 50 minus, 50 multiply 60%, which is 30. Okay. Now then moving on to step 3. You take adjustment of cost of goods sold as a balancing figure. Okay, so take this as a balancing figure. So 1, 2, 3 step. You got 3 line adjustment. Now the step 4 is related to the tax effect entries. Okay. Now when you have step 2, the adjustment of the inventory, which represent the unrealized profit contained in closing balance inventory, you will have step 4. Okay. Now assuming if all the inventory were sold, then you debit sales 150, right? Credit cost of goods sold 150. There's no need to adjust inventory. And when all the inventory were sold, there's no unrealized profit, right? There's no need to adjust for the tax. Because we have unrealized profit contained in closing balance inventory, which is eliminated, that's why you need to prepare tax effect entries. So 30 times 30% tax rate, so income tax expense reduced by 9, and we debit DTA. That's it. Now this method can be applied for all the current year intragroup transferred inventory, assuming transferring price greater than the original cost. Now you may wonder, what if the transfer price lower than the original cost? Now let's look at the summary too. Okay. Now here we are assuming transfer price lower than original cost. Now we are first assuming cost is 150 now. Intragroup transferring price become 100. Still assuming 60% inventory on hand. Okay. So you can see step 1 still same, right? It's the elimination of the intragroup sales revenue in full, but the number now has been changed to 100. Now then step 2, adjust the carry amount of the inventory. So you can see adjustment is not on the credit, it's on the debit, because the inventory transferring price lower than the original cost, showing that after transfer, the inventory is undervalued, right? It's understated, the amount is understated. So from the group viewpoint, we need to increase the carry amount inventory. So again, using the same formula, but I just need to put to get the positive figure, right? In order to get positive figure, we have to put the cost in the front. So cost minus transferring price. So that is this represents the loss from the intragroup sale of the inventory. The total loss from the intragroup sale of inventory multiplied by the percentage inventory on hand. So this is unrealized loss contained in closing balance of the inventory. Okay, and after that, step 3 is still same, right? So these make it to adjust the cost of goods sold as a balancing figure. Okay, so pay attention to the inventory adjustment. So whether adjustment should be on the debit or credit, it depends on whether the intragroup selling price is above or below the original cost. Yeah. Now let me know if you have any question here. Okay, just raise your hand. Okay, you can ask questions. The questions are always welcome. Now then, finally, tax adjustment. Now, because the elimination of the loss will result in a profit group increase, right? So profit group increase, therefore increase the income tax expense of the group. And on the credit side, we credit DTL. Now, why DTL? Let's go back to the inventory adjustment here. You debit inventory, which increase the carrying amount, increase the taxable temporary differences. That leads to recognition of DTL. All right, now, so this is your current year inventory transfer. So let me know if you have any question at this stage, okay? If you do have a question, now we will test your understanding. Now, so we can use the 4-step methods, okay? We introduce to solve this question. So have a look at 4 options, which one is correct. Now, all the inventory still on hand. So you do have unrealized profit contained in closing balance of the inventory. Gaofeng, did you get your answer? Not yet. Yeah, no worries, take your time. Chen Tao, what do you think? The last one, D. Okay, let's ask one more. Yijun, Liu Yijun, yes, what's your opinion? Do you agree with Chen Tao? The last one as well. Okay, so 2 of you agree the right answer is D, the last one. That is very good, okay? So you can see the total profit from the intragroup transfer item is 12,000, right? Because all the inventory were still on hand, which means all this profit remains unrealized and contained in closing balance of inventory. So your adjustment should involve a credit inventory by 12,000. What about debit? There should be a debit sales revenue 72,000, right? Is it? Because the profit is equal to transferring price minus the original cost. So the transferring price is not given, but we know the profit from the intragroup sale. You can figure out the transferring price, right? So there will be a debit of sales that is 72,000 by using 60,000 original cost plus the profit 12,000. That represent intragroup transfer price, okay? And then we know inventory should be credited by 12,000 because the unrealized profit of 12,000 contained in the closing balance of the inventory accounts. Okay? Now balancing figure, we credit cost of goods sold, which is 60,000. So you can see the elimination of these 60,000 cost of goods sold is actually related to the intragroup cost of sale, right? The intragroup expenses here. Okay. So that's why you choose the last one as the correct answer. Well done. Okay. Now let's try this one. Now this one a bit confusing here, right? It seems that none of the options is correct. But if you record 2 separate entries, instead of one single entry here, you can record 2 separate entries, right? If you record 2 separate entries, which is the correct answer? Lu Chang. Yep, what do you? Which one you think is right if you consider two separate entries instead of one single entry? So debit sales against cost of sale, right? So what is the debit sales? The answer is here, 72,000, right? 72,000. So because all the other numbers are absolutely wrong. Okay? It seems that only A is correct if you prepare two separate entries. So when you debit sales, eliminate intergroup sales against cost of sales, 72,000. And then we adjust inventory, credit inventory, then there will be debit cost of sale of 12,000. So, well, it's better just give you credit cost of sale 60,000. So that is easy to find out that is the right answer. Okay, so I will make sure I will do that in the exam. So again, so in the quiz question, I will only give you 3 lines. If it's a journal entry question, so only 3 lines for the first entries, in case combined entries, and a separate entry for the tax. Okay, now one more. Now, in this example, 75% inventory were already sold to the party outside the group. We got 25% inventory still on hand. So I would suggest to figure out the inventory adjustment first. Then you will get cost of sale adjustment by taking a balancing figure in the entries. Yingchen, Mao Yingchen, Yingchen, yeah. Which one you think is right? C? C? Okay, now let's see, Xiangqi, Meng Xiangqi. Do you agree, C? Which one you think is right? Oh, you're not sure, that's okay. So, but if it's an exam question, don't leave as a blank, okay? So you have to choose one. But here, that's fine, don't worry about that. So which one is right? Well, C is correct, right? C is the correct answer. So how we work this out? Now you can see the intragroup selling price is 100,000. The original cost is 90,000. So the difference, 10,000, represents the profit from this intragroup sale of inventory. Are these profit realized? Oh, let's move on to look at the other information. 75% sold, which means 75% realized. Well, 25% remain unrealized, right? So 25% of 10,000, the credit inventory adjustment should be 2,500. Very good. Okay. Now, what's wrong with the cost of sale? Well, the cost of sale adjustment should equal to 97,500, right? We're using 100,000 minus 2,500 to get 97,500 of the cost of sale adjustment. So that's why A, D, all wrong, right? Okay, now let me know if you got any question. Let's see the next one. Now this asks you for the tax effect entry, the tax entry. So I will try to figure out whether adjustment of the income tax is on the debit or credit. Okay. So what is the profit from the intragroup sales? And then identify the unrealized profit that required to be eliminated in the worksheet, right? Clipchamp? Oh, yes, then what do you think? So 3,600 is right number, right? How do we get that? 48,000 minus 36,000, the difference is 12,000, right? 12,000 profit remains unrealized, so we need to multiply 30% to get the tax effect adjustment. So 30% of 12,000 is 3,600. But which option here shows the correct tax effect entry in the worksheet? What do you think, Clipchamp? So income tax expense should increase or decrease when your profit is eliminated, which means group profit reduce. So income tax expense would increase or decrease? Profit decrease, tax decrease, right? So AB is definitely wrong because AB show increase. Doesn't make sense, right? The profit decrease means tax should also decrease. So C or D? C. It's a recognition of DTA. Why DTA? Because you need to adjust the inventory carrying amount down by 12,000. So when the inventory carrying amount is lower than the tax base, that is deductible temporary differences, which leads to the recognition of deferred tax asset. So you can see whenever asset adjusted downwards, you recognize DTA. Recall your RSC entry, the revaluation surplus on consolidation entry we did in the previous session. You adjust item like a land, the building upwards, right? Which type of deferred tax you recall? DTL. Right? When asset adjusts upwards, increase the taxable temporary differences, you recognize DTL. But when asset adjusts downwards, it should be the other way around, right? You should recognize DTA. Okay. So C would be the right answer. Okay. Now, so that is all for the unrealized profit in closing balance inventory. Now let's move on to look at the unrealized profit in opening inventory. Now assuming go back to our original example, the inventory is sold, right, between entity from the subsidiary parents in year 22, okay, and not sold by end of that year. Then we have to consider how these affect year 23 consolidated accounts. Because this inventory will become the opening inventory of year 23, right? And will be sold in year 23. Now you may ask, how do you know it's sold in year 23? Because inventory is a current asset. Now that is our reasonable assumption. We always can assuming opening inventory will be sold by end of the year. Okay, so it's a reasonable assumption because inventory is a current asset. Unless you have been told otherwise, we should always make this assumption. And then once the inventory is sold to the outside party in the following year, the unrealized profit at the beginning, right, of the period will be realized by the end of the period. Okay. All right, then how you are going to make your worksheet adjustment? Because the integral transfer inventory occurred in the prior year, right? It is contained in the prior year worksheet. There is an elimination of the integral sales revenue, cost of sale, and the ITE, right? Adjustment of ITE. Now, remember your worksheet adjustment is a notional adjustment, right? Notional adjustments. They are not real entries. So these adjustments have no impact on the parent or subsidiaries individual record. No impact at all. So you can see if the subsidiary is a seller, this profit from these from the intragroup transaction resulting from intragroup transaction, right, still contained in subsidiaries record, and it will be carried to the next year. Okay. Now, it is necessary to eliminate this unrealized profit contained in opening inventory by adjusting of your retained earnings. So the retained earnings account contains these unrealized profit from the prior year intragroup transferred item. Okay. Now, these two entries can be combined, all right? So because this is related to prior year ITE adjustment. Okay. This is a current year ITE. So why there's a current year ITE adjustment? Because once the inventory was sold, adjustment made to cost of sale. And the credit of a cost of sale effectively reduce the current year group expense and therefore increase the group profit for the current period. When group profit increase, income tax expense of the group should also increase. So basically you can see the unrealized profit contained in opening retained earnings, well, you can just make adjustment for after tax basis, right, will be realized in the current year, right? So you can see current year group profit increased, right, increased through adjustment of cost of sale and ITE. Now let's give an example. So let's go back to our original example, the first example we did earlier. Subsidiary acquired the inventory from an entity outside of the group, paid 100. Sell this inventory to the parents for 150. Okay. End of the year 22, all this inventory still on hand. And then this inventory sold during the year ended on 23. So you can see here on 30 July, that is for the year ended on 23, right? 30 June 23. Okay. Now you can see when worksheet entry is prepared on 30 June 22, that is in the year when this intragroup transaction took place. Now we have the following elimination entries prepared in the prior year worksheet, right? Including elimination of the sales revenue, adjustment to the inventory, elimination of the cost of sale, and the tax effect entries. Now, all these entries, they are notional adjustment. They are not real entries. These entries have no impact on parent subsidiary's own record. Okay. Because this inventory is still on hand, still within the group, which means this inventory has a continued effect on the following year consolidated accounts. That's when you prepare consolidation worksheet for the year ended on 30 June 23, but you have to carry over all the prior year adjustment its effect to the following year. You can see prior year sales revenue, cost of sale, ITE, all close to retained earnings. So instead of having two separate entries, you can just combine this line, two lines, and the debit retained earnings for 35. Okay, so that is based on after-tax adjustment using 150 minus 100 cost of sale, right, minus 15 income tax. Now, because the inventory was sold during the year 23, adjustment made to cost of sale. Right, and the cost of sale reduced by 50, increased the group profit in this year by 50. And the group profit increase, income tax expense should also increase. So 30% of 50, the income tax expense adjust on the debit side by 15. Now, once again, combine these two entries. Okay? So combine these two entries. Now, do you have any entries in year 24? Do you need to carry over these to the next year? No, right? So once it's all realized, that's end of story. Okay? So if you carry over all these to what happens? Oh, there's a retained earnings adjustment, which is 0. Impact is 0, right? So no need to carry over, no further entries required in the future year relate to these. Once the profit is realized, that is the end of the story. Okay? All right, now, so this is all for our intragroup transfer of the inventory. So have unrealized profit contained in closing balance inventory if this inventory transfer took place in the current year, right? Part of this inventory remains unsold by end of the current period. So you have unrealized profit contained in closing balance inventory. And these closing balance inventory for the current year become opening balance inventory of the next year. So you can see you have unrealized profit in the opening balance of the inventory in the following year. Okay? And your adjustment is required in the following worksheet, right, to show the elimination of unrealized profit contained in retained earnings and adjustment to the cost of sale if this inventory is sold to the outside party during the current year. Now, always can make a reasonable assumption. Opening inventory will be sold by the end of the current year. That is reasonable assumption. Unless you have been told otherwise, we always assume opening inventory will be sold by the end of the financial period. Now, the challenging part is related to PPE transfer. Now, this is a bit more difficult, as you have to consider subsequent year depreciation adjustment. Okay? But the underlying principle is actually the same. Right. So again, I would suggest you to process the entries recorded by each legal entity and identify any gains or loss from the intragroup transfer. PPE, because they remain unrealized, as this transfer PPE usually will be within the group for use rather than for resale. Okay. Then you have to eliminate these intragroup gains or loss, and also have to consider its subsequent depreciation adjustment. Okay. Now, once you have to be very careful, you should always ask yourself a first question, that is, when this intragroup transaction took place. Is that a current year transfer or prior year transfer? Because different accounts will be adjusted if this transaction took place in the current year compared to the prior year. Now, if transaction took place in the current year, it is a current year either gains or loss on sale, right? Current year IT required to be adjusted. If related to the prior year transferred item, then you need to adjust opening retained earnings. Now, so you can see for the inter-entity transfer of the PPE, you also have to consider tax effect entry if there's any unrealized gains or loss from the group viewpoint. Okay. So if the gains remains unrealized, then we need to eliminate these intragroup gains, right? And we also need to adjust carry amount of the PPE. So usually adjustment will result in carry amount PPE lower than tax base. So based on assumption, the transferring price is above the carry amount item sold. So the seller therefore recognize a gains. And that gains is remain unrealized from the group perspective. Now, if the selling price is lower than the carry amount item sold, then the seller record loss on sale. Okay. And if it's a loss on sale, adjustment for the carry amount item will be greater than its tax base, right? So resulting a carry amount greater than tax base, and then should lead to recognition of DTL. So it depends on whether the seller record a gains on sale or loss on sale. So that's the reason why I would always suggest you to process the entry recorded by each legal entity before you move on to look at your worksheet adjustment. Okay. Now let's take the following question as an example. Now, assuming that Jessica sold to Amelia. Now, their relationship, parent subsidiary, of course. Now, Jessica is a parent holding all the shares in Amelia. Okay? And the parents, Jessica, sold Amelia a plant for $18,000 cash on 1st July 22. Now, if the cash information is missing, you're assuming that it's a cash transaction unless we specify it is a credit sales in the question, right? If we didn't specify it's a credit sales transaction, you're always assuming this intragroup transaction is a cash transaction. Okay? Now, the plant arrangement cost Jessica $20,000 when acquired 4 years previously. So you can see before the transfer, the plant is used by Jessica, has been used by Jessica for 4 years. So we need to identify the carrying amount of the plant in the record of Jessica immediately before the sale. So how do you find carrying amount? Cost minus accumulated depreciation. Now we know the cost, that is $20,000. So what is accumulated depreciation? Let's calculate annual depreciation first, right? That is $20,000 divided by 10 years. So $2,000 each year. How many years? 4 years. So 2,000 multiplied 4 years, the accumulated balance will be 8,000. Now, by using cost 20,000 minus accumulated depreciation balance 8,000, the carrying amount is 12,000. Okay. Now, once we know the carrying amount, then we will be able to figure out the gains on sale recognized by the seller, Jessica Limited, right? The gains on sale is equal to the proceeds on sale, that is reference to our intragroup selling price, 18,000, minus the current item sold, 12,000. The difference, 6,000, is the gains on sale recognized by the seller, Jessica Limited. Well, Amelia would record the plant cost for 18,000 because that is how much Amelia paid to acquire the item from Jessica. Okay? And from Amelia's perspective, the 18,000 represent the total depreciation amount. And by using 18,000 divided by remaining useful life is 6 years, right? 10 minus 4, remaining useful life is 6 years. Then Amelia would record a depreciation based on 18,000 divided by 6 years, which is 3,000 each year. What about from the group viewpoint? From the group viewpoint, the remaining depreciation amount is 12,000, right? Represented by the carrying amount of these items immediately before the transfer. Now, by using 12,000 divided by 6 years, the group should report depreciation of 2,000 each year. Now, you can see the difference, again, is what you need to adjust for consolidation purpose. So we can actually summarize the step involved in your consolidation process in relation to the elimination of intragroup transaction. First step, we have to identify whether the transaction is current year transaction or prior year transaction. This is always our first step, right? Second step, identify the legal entities record of these transactions. And then compare that with the amount that should be reported by the group. Now the difference is your worksheet adjustment, right? The difference represents your worksheet adjustment. Now let's apply this step in this question. Now step 1 is done. It is a current year transaction, assuming current year ended on 30 June 23. Okay. Now then let's move on to look at each legal entity's record. Jessica, as a seller, received 18,000 cash, right? De-recognize the plant from its balance sheet. By debit, accumulated depreciation, 8,000, credit plant cost, 20,000. Now this item now has been de-recognized from Jessica's record. Now Jessica then recognized gains on sale for 6,000. So you can see the gains is included in 6,000 gains is included in Jessica's current year profit and loss, and then Jessica paid tax based on that, right? However, from the group viewpoint, we don't need to pay tax for these gains. And from the group viewpoint, these gains on sale remains unrealized and required to be eliminated in the worksheet. Okay. Now then move on to look at Amelia's record. Amelia recorded plant cost 18,000 and then paid 18,000 cash. Now what do you adjustment? You need to adjust carrying amount of the plant, right? Because it is overstated by 6,000. Now, do we just directly credit plant 6,000? Now, that is not really appropriate adjustment here, okay? So I will show you the appropriate adjustment. Here we go. So we are going to have a look at these analysis. So you can see the group position is actually represented by the record in Jessica immediately before the transfer, right? So these record in Jessica also represent the group position, okay? But after the transfer, Amelia recognized the plant cost as 18,000. What is the original cost to the group? 20,000. So you can see the difference, 2,000, is your adjustment in the worksheet. Now then you look at accumulated depreciation. Well, there's no balance immediately after transfer in the record of Amelia, right? But from the group viewpoint, this item has already been consumed. And this item should have a cumulative balance of 8,000. So this balance then will be reinstated in your adjustment in the consolidation worksheet. So based on this analysis, let's go back to our worksheet entries. Let's jump to, here we go. Let's have a look at our worksheet entries. So again, the worksheet entries includes elimination of the unrealized gains from the intragroup transfer PPE, right? So debit gains on sale. And also involve adjustment of the plant cost because currently recognized by Amelia as 18,000, but from the group viewpoint is 20,000. So we need another 2,000 adjustment in the worksheet. Accumulation balance after transfer is 0, but from the group viewpoint, we should report 8,000 balance on the credit. So that's why you reinstate this amount in the worksheet. So you can see debit plant cost, credit accumulated depreciation. Well, there is a 6,000, right? So 6,000 of the plant carry amount is effectively reduced by 6,000 after these two-line adjustment. Okay. Now, in addition to that, we have to show the tax effect. No gains, no tax. The gains reduced by 6,000 reduce group profit, therefore reduce the income tax expense of the group. So 6,000 times 30%, that is 1,800. In addition to that, we need to recognize DTA. Because the current plant reduced by 6,000, this create the double temporary differences. 6,000 multiplied 30% tax rate. Now, alternatively, if we go back to look at the entries recorded by Jessica, you can see Jessica paid tax for the gains. But from the group viewpoint, this is advanced tax payment made by Jessica. And that's why DTA represent future tax benefits, right? So also raised due to the advanced tax payment made by the legal entity. Okay. All right, now, so that is on worksheet entries on 1st July 22. That is immediately after the transfer. But we should consider the worksheet entry at the reporting date, which is on 30 June 22. Okay. Now let's take a short break from now, and you guys think about what is our worksheet entry at a reporting date. So is there any additional entries required? Most likely, because plant is a depreciable item, right? So we have to consider depreciation adjustment. Okay. Now let's take a 10 minutes break from now, and after that, we are going to continue our discussion of this part, okay? That's what you, that's mathematically, that makes sense. Yeah. Thank you. No problem. If any problem, let me. How many members do you have right now?
No, 4.
Including her? No. Okay. So these persons coming back. He's not coming to the class. Yeah. Okay. Okay. Also, all this one. I think she is an active. I'm not sure if she's an active member or not. I just double check that. So whether she's on or he's online. He's still active. He's logging online like 53 minutes ago.
Yeah, I sent the email. Yes, you did.
It's not replying.
Yes, no.
Okay. Okay, and then I will just chasing these up, okay?
Yes. Thank you.
Won't be that quick.
Yes.
Okay, it's coming. Oh, another one. First, I'll just reply everyone. No, that's not a good idea. Forward, yeah. I put this as a important. Okay, I'll see in other option. Not sure how to do that. Okay, it's a string A, right? It's string B. Option saying this is important email, but I can't remember because I usually don't use that use that function.
Sometimes I only type in important.
Oh, here, important highlight. Okay. Actually, important is highlights. Set this as a highlight. I'm not sure if the setting is successful. I don't think so. I will see it back to you. Okay.
LANX.
You receive that?
Yeah.
Think that she's active here, but I don't think. Oh, it was in the class last week. But you didn't get a chance to. Oh, you didn't get a chance to meet her last week because she is here last week.
I have it.
Okay, all right. So I was just like calling down the name. So probably I'm not sure, but I think.
Maybe I can put it
Yeah,
to
yeah.
the class.
Yeah,
Thank
no
you.
problem. Okay, guys, now let's continue our discussion of this question. Now we are assuming the worksheet entry is prepared on 30 June 23. The 1st July 22 is the beginning of the current year, right? 30 June 23 is the end of the current period. Okay. Now, if the worksheet adjusting entries prepared on 30 June 23, now you need to record this part, right? So this part same, no difference. But in addition to that, we have to think about depreciation adjustment. So let's look at this. Here we go. Now the depreciation adjustment in the record of Mamilia is equal to the cost of Amelia is 18,000 divided by useful life 6 years. That is 3,000 each year, right? Now you might notice that the profit will become realized once the item is sold to the external party or used through the use. But for PPE, most likely through use of the item by adjusting of depreciation. Okay? So Amelia recognized depreciation expense of 3,000 each year in its accounts. Well, from the group viewpoint, the remaining depreciation amount is actually represented by the carrying amount immediately before the transfer, that is 12,000 divided by 6 years, which is 2,000. Or we can use the original cost divided by 10 years, which is the total useful life, right? Also 2,000. So from the group viewpoint, we should report 2,000 depreciation. However, in the record of the legal entity Amelia, there is a 3,000. Now that is overstated by the legal entity, right? So the depreciation expense is 1,000 higher in the record of legal entity, therefore need to be adjusted downwards in the worksheet by 1,000. Now let's look at our worksheet entries on 30 June 23. Now the first two entries same as previously discussed, okay? But in addition to that, we should adjust for 1 year depreciation expense, reduce depreciation expense, okay? And then then debit accumulated depreciation. Now because the depreciation expense adjustment here effectively reduce the group expense, therefore increase the group current year profit. Now when group current year profit increased by the depreciation expense adjustment, we should show an increase of income tax expense, right? So we debit income tax expense 300, which is equal to 1,000 depreciation adjustment multiplied by 30% tax rate. Okay. Now then finally we show a reverse of DTA. Now someone asked me, why not credit DTL? Now be careful. The adjustment of depreciation resulting a reversal of the DTA you previously raised, right? As a result of the karma adjustment of the plant. Now you're not recognizing DTL here. You are reversing the DTA balance you previously raised, okay? So that's the reason why DTA balance here reversed by 300, reduced by 300. Okay? Now this is your worksheet entries on 30 June 23. What about 24? Well, apparently this transfer item has a continued effect on the following year consolidated accounts because this item is still within the group, right? It's still within the group. So what is our adjustment on the following year worksheet? The gains on sale, the ITE close to retained earnings, right? The depreciation expense, ITE also close to retained earnings. So remember that all the prior year adjustment of the revenue expense, when you need to carry over its effect to the following year, we need to adjust opening retained earnings. Because revenue expenses, they are temporary accounts, required to be close to retained earnings as part of closing procedure by the end of reporting period. Now let's look at year 24 worksheet entries. So you can see last year debit gains on sale, now close to retained earnings, right? So you can see the retained earnings adjustment is based on the after-tax, prior year after-tax intra-group unrealized gains. So that's 6,000 minus 1,800 tax. Okay? So the after-tax unrealized gains, which is contained in opening retained earnings, need to be eliminated by debit retained earnings for 4,200. Now adjustment of the plant cost, accumulated depreciation, DTA, now they are permanent accounts, right? They're all assets, they're permanent accounts. We just need to copy this down, right? You just copy down this straight line. Now, in addition to that, we should show depreciation adjustment for year 24, because straight line method is applied here. So each year, your adjustment of depreciation expense here will be same over 6 years period, right? So credit depreciation, again, 1,000. But you need to carry over prior year adjustment of the depreciation. Now you credit retained earnings. So this is carry forward the prior year depreciation adjustment is effect to the current period worksheet. Okay. Now, accumulated depreciation adjustment should reflect 2 years of your adjustment. So each year, 1,000, 2 years, 2,000. And then we're going to show tax entry, right? So you can see your income tax expense increase because the depreciation expense decreased, right? So depreciation expense decreased by 1,000, which effectively increase the group profit, therefore increase the income tax expense of the group. So using 1,000 multiply 30%, which is 300. What else? Don't forget to carry over prior year IT adjustment. Its effect to the current year. So prior year you have 300 IT adjustment, right? And now we carry its effect to the current year by debit retained earnings of 300. Right. Now DTA reverse for 2 years. Each year 300, 2 years 600. Now following the same rules principles, you can prepare entry on 30 June 25, right? This entry, the first entry, same, I just changed the year to 24. That's it, right? What about this line item? Accumulated depreciation in year 25? 3,000. Depreciation adjustment still 1,000. Retained earnings 2,000. Income tax 300. Retained earnings 600. DTA 900. That's right. Okay. All right. Now let's look at the following MCQ. Now the profit here should be after tax, right? After, what is the impact of your adjustment on the after-tax profit of the group? 成语是成语 成语 not here. Zizou, Song Zizou. Yep. What do you think? C? C? Okay. Let's see someone else's opinion. Su Zongyao. Zongyao, what do you think? Agree? C? Or you have a different opinion? You think it's C as well, okay? I think we did. Okay, now why is not C? Okay, so answer is D. Why is D not C? Let's have a look at what is C. Increase. Is that increase or decrease? The C is the exactly opposite, right? Is that increase? You prepare necessary worksheet adjustment in relation to the transfer of the plant. What is the impact of your adjustment on the group profit? It's not an increase, it's a decrease. Why is that? Because the seller, Joe Limited, right, sell this item to subsidiary, Wu Limited, and the intragroup selling price is 100,000. What is the carrying amount of the item sold? That's 80,000. If you use 120,000, that would be wrong, because in that case, the seller record loss on sale, then you might get the right answer, okay? But you don't compare the selling price with the cost, you compare the selling price with the carrying amount on the day of the transfer, okay? So you can see the original cost is 120,000. The accumulated depreciation is 40,000. How do we get that? 120,000 divided by 6 years, right? And multiplied by 2 years, that's right. So you can see before the transfer, Joe had used this item for 2 years already, right? So 120,000 by 6 years, you have 20,000 depreciation each year, and used by Joe Limited for 2 years, there is a cumulative depreciation balance of 40,000. Now this gives you the carrying amount that is 80,000. Now you can see the transferring price is above the carrying amount, right? Means the seller would recognize a gains on sale. But such gains should not be included in your consolidated amounts because it remains unrealized from the group viewpoint. Therefore, your elimination entries involve a debit of gain on sale, right? Which is equal to, oh, sorry, my mistake, 20,000, because there are 20,000 gains on sale. In addition to that, there will be a credit of plump, right? So yes, it's a credit of a plump for 20,000 because the cost to the group is 120,000, right? And after transfer, it is recorded as 100,000. Ooh, the adjustment should be on the debit side. Right? Adjustment should be on the debit side. 20,000. And then you credit accumulated depreciation. That is 40,000. So you can see debit plump cost, credit accumulated depreciation. Now this effectively reduce the carrying amount of the plant by 20,000, right? What is the plant cost to the group? What is the plant cost to the group? 120, right? What is the cost after transfer? 100. You need to adjust the debit for another 20. What is the accumulated depreciation after transfer? That's 0. But what should be reported by the group? 40,000. So that's why you reinstate this amount in your worksheet. Mm. It is 80,000. That's right, it is 80,000. See, after transfer, it's Wu Limited, right? What is a Wu's record? Wu's record of a plant is 100,000, that's right. What's your adjustment here? You adjust 20, right? 20. Here, on the debit. And you adjust accumulated depreciation, 40, right? So here, the group position now is 120 minus 40,000 accumulated depreciation, which is equal to 80. So you can see the group position is actually the carrying amount should be same as the position of Joe Limited immediately before the sale, right? Immediately before the sale. So you can see these two line adjustment effectively reduce the plant carrying amount down by 20,000. Okay, down for 20,000. So then, which is the right answer? Well, a decrease in current year profit. Why 14? something is missing here. What is that? Tax. Right? So there is a debit of ETA and a credit of income tax expense, 30% of 20,000, which is 6,000. So profit of the group, therefore, will be reduced by 20,000 minus income tax 6,000, which is 14,000. Right? So the group profit after tax profit reduced by 14,000, and the carry amount of the plum also reduced by, right? But here it reduced by 20,000. Okay. Now then, D would be the right answer. So let me know if you have any question with this calculation and entries. So any question? Let me know. All right, now the most challenging part is actually this one. Transfer between inventory and non-current assets. So what is that? The transfer item, its classification may change. For example, before the transfer, it is an inventory. So therefore the seller sells inventory, right? But after the transfer, the buyer intends to use this item as a PPE. So you can see transfer from inventory to PPE. Could be the other way around. The seller sells PPE, but the buyer recognizes transfer item as an inventory. For example, if the parent company manufactures machine, right? What is a machine to the parent company? Inventory, right? Because they're manufacturing the machine and sell this machine to the end customer. So from the parent's perspective, well, the manufactured products, the machine, is their inventory. Say parents sell one of the machine to its subsidiary, and the subsidiary intend to use it as a PPE, recognizes acquired item as a machine, which is their non-current asset. And of course, these non-current are subject to annual depreciation. Okay. So when seller recognizes sale of an inventory, it is a sales cost of goods sold that will be required to be eliminated in the worksheet, right? And when the buyer recognizes acquired item as a machine, then it is the current amount of the machine that need to be adjusted in your consolidation worksheet. From inventory to PPE is a bit more challenge because you have to consider subsequent year depreciation adjustment. If it's from PPE to inventory, that'll be rather simple. You don't need to worry about depreciation. There's no depreciation applied for the inventory. Now, what is from PPE to inventory? For example, if the subsidiary entity specializes in selling second-hand machine, right? And the parent entity sold one of its used machine, old machine, to subsidiary. So you can say parent sells PPE, right? Well, the subsidiary will recognize this as an inventory. Okay. Now, so the key is to identify which accounts are required to be eliminated or required to be adjusted in your consolidation worksheet. So again, I would suggest you to process the entry recorded by each entity first. Now let's look at the following example. Now Amelia is a wholly owned subsidiary of Jessica, and Amelia sells inventory to Jessica on 1st July 22 for 6,000 cash. Now the item costs Amelia 4,000 early in the current year. Now Jessica intends to use the item as plant with a useful life of 10 years, no residual value. Jessica applies straight line depreciation methods. Now let's look at the entries recorded by Amelia. Now remember that Amelia sells inventory. Therefore, Amelia will record a sales revenue for 6,000 and recognize the cost of sale of 4,000 in its accounts. However, Jessica intends to use this acquired item as a plant, which is PPE. Therefore, Jessica recognizes transfer item as plant, right? That is a PPE, right? Based on 6,000 purchasing price. What should be eliminated in your worksheet? the intragroup sales revenue, right? The intragroup cost of sale. Which asset accounts should be adjusted in the worksheet? Tell me, inventory or plant? Which asset account is currently need to be adjusted, inventory or plant? Not both. Plant, right? Because the item is recognized by Jessica as a plant, and it is a plant, its carrying amount is overstated compared to the group. From the group viewpoint, the plant should show a balance of 4,000, represent the original cost to the group. After Jessica acquired this plant, recognized 6,000, now this is overstated by the legal entity, right? Need to be adjusted in the worksheet. So you can see your consolidation worksheet includes the elimination of intragroup sales revenue, the cost of sale, right? The cost of sale combine these two lines. The cost of sale for 4,000. And the adjustment for the carrying amount of the plant, not inventory. Okay, so pay attention. There is a change in the classification of the transfer item. Now then we're going to show the tax effect entry. The profit of 2,000 remains unrealized, now is eliminated in the worksheet. Profit decrease, tax of the group should also decrease. So 2,000 times 30% tax rate, your income tax expense reduced by 600. Because the amount of plant reduced by 2,000, now these create deductible temporary differences. That leads to the recognition of DTA. Anything else? Any other entries required in the worksheet for these transfer items? It is a plant, which means depreciation adjustment should be considered, right? Now, when this transaction took place, go back to the question, 1st July 22, which is the beginning of the current year, then our adjustment of depreciation should show a year, 1 year adjustment, right? Now, if you look at the depreciation expense recorded in Jessica's book, that is equal to 6,000. That is the cost of the plant to Jessica, right? Divided by useful life, 10 years, which is 600. However, from the group viewpoint, the total depreciation amount represented by the cost of this item to the group, that is only 4,000. And the 4,000 divided by 10 years, 400 depreciation should be recognized or should be reported by the group. So you can see the difference represent our adjustment in the worksheet. So we compare what is recorded by the legal entity with the amount that should be reported by the group. The difference is your worksheet adjustment amount, right, for that accounts. So then we credit depreciation expense of 200, debit accumulated depreciation, then show the tax effect of your depreciation adjustment. Depreciation expense decrease. This will increase the group profit by 200. Now, group profit increase, income tax expense of the group should also increase. So 30% of 200, income tax expense increased by 60. Right. And on the credit side, we show reverse of the DTA. Okay. Now, let's extend this question a little bit. Okay. Now, this is your year 30 June 23 worksheet entry. What about the question asks you to prepare worksheet entries on 30 June 24? Would be your worksheet entries on 30 June 24. So prior year adjustment, right, of the revenue, cost of sale, ITE, all close to retained earnings. So it will be a debit of retained earnings, opening balance, right, which is equal to So 6,000 minus 4,000, that is 2,000 unrealized profit before tax, right? 2,000 minus income tax 600, that is 1,400. That's 1,400. I need some space for the tax and depreciation entries later. 1,400. And then we debit DTA, right? So just copy down this line, 600, and then we credit. What's the credit? Plant. Always credit plant, right? That is 2,000. Now, what else? Depreciation adjustment, right? So you should include a depreciation adjustment. Okay. You have a credit of income, depreciation expense. Now, each year adjustment will be the same because straight line method apply. So year 24 adjustment is 200. Okay. Now, your year 23 adjustment, you carry forward to the current year, adjust opening retained earnings, that is also 200, right? So together, 400, we adjust accumulated depreciation. So accumulated depreciation adjustment should reflect 2 years of adjustment here. Anything else? Tax, right? So then we are going to debit income tax expense for the year. Well, due to this depreciation adjustment, income tax expense increased by 60 for the current year. And also retained earnings, right? And then we credit DTA reversed by 2 years, each year 60, 2 years 120. Okay. So any other question? So let me know, okay? Now, if the worksheet entries are required to be prepared on 30 June 22, now this is your answer, all right? If the worksheet entries asked you to required to be prepared in the year when these transactions took place, but you should adjust the revenue, cost of sale, right? Okay, so let me know if there's any question, right? Okay. Now then moving on to the second type. So this scenario is actually rather simple from PPE to inventory. But I will extend this question a little bit more later, okay? Make some variation. Now, let's look at the example here. We got 16 May 22. Jessica sold equipment to Amelia for 50,000. Now, these assets having a carry amount at time of sale of 40,000, which means Jessica as a seller recognized 10,000 gains on sale, right? So there's 10,000 gains on sale by using 50,000 minus 40,000. There's 10,000 gains on sale recognized in Jessica's record. However, from the group viewpoint, these gains remains unrealized and required to be eliminated. Okay, so you can see one line of your elimination adjustment, including gains, debit gains on sale. So these two eliminate the unrealized gains resulting from these intergroup transfer item. Now, the seller sells PPE. But what happened to the buyer's record? Now, the equipment was regarded by Jessica as a depreciable item, but Amelia recalled these as inventory because Amelia sells second-hand machine, for example. Okay. Now, and these items already sold by Amelia to the party outside of the group. So you can see there is no unrealized profit, right? So when inventory was sold by Amelia, Amelia recalled the cost of goods sold of 50,000 because that is how much Amelia paid to acquire the item, right? However, from the group viewpoint, the cost of goods sold should be 40,000, represented by the carry amount at the time of the transfer, right? So you can see the cost of goods sold in the record of Amelia is overstated by 10,000 and therefore need to be reduced in the worksheet. What is there any impact of these two line adjustment on the group profit? Is there any impact on the group profit? No, right? Because there is no unrealized profit loss from the integral transfer item. And the elimination of the gains, adjustment of the cost of sale has zero impact, right? Or resulting zero impact on the group profit. You don't need to prepare any tax entry because there's no impact on the profit. No need to prepare tax. There's no tax effect, right? There's no tax effect. Now, what if, let's make this question a bit more challenge. Now, what if this inventory is still on hand? What if this inventory is still on hand? What would be your consolidation worksheet entries? So assuming all these inventory remain unsold. If it remains unsold, well, your debit gains on sale is still same as before, okay? But you no longer credit cost of sale for 10,000. Instead, you should adjust carrying amount of the inventory down by 10,000. And in addition to that, we have to show the tax effect entry because the unrealized gains, which is not realized from the group viewpoint now, is eliminated, right? And these unrealized gains is actually contained in closing balance inventory. Right? So that's the reason why inventory carry amount need to be reduced down by 10,000. Now this resulting a tax effect entry. No gains, no tax. So tax reduced by 3,000, that is 30% of 10,000 gains, right? And then we debit DTA. Now, because the inventory is still on hand at the end of 30 June 22, it will be sold by year ended 30 June 23. Now, that is, again, a reasonable assumption. So opening balance inventory are expected to be sold by the end of the financial year. Okay? So you can see our worksheet entries on 30 June 23 showing the inventory were sold to the outside party, the adjustment made to the cost of sale. The unrealized profit contained in opening retained earnings now is realized in the current year when the inventory is sold to the external party. Okay, now up to here, now this end of story. No more entry in the future period. Okay. So we just make this question a bit more challenging. So instead of assuming all these inventory were sold, let's assuming what if they are still on hand. Okay, the entries that require to be recorded in the year when the transaction took place and in the following year once this item is sold to the external party. Now, any question? Any question? Let me know if there's any question. Now, these notes are available on Moodle, okay? So you can just download these documents on Moodle straight away. All right, now you can do some exercise to test yourself whether you understand these or not. Okay. Let's look at this MCQ question. We got the answer. Wang Changyi. The last one, D. Okay, take a second thought. Is there any change in the classification of transfer item? Smith sells inventory, right, to John Limited. But John intends to use this item as plant, which is a PPE. Which one? The second one, right? So we correctly identify the amount of adjustment, or they all same. But I will give you some different numbers later. Then the key is to find the correct account's name, right? Accounts that need to be adjusted. So you can see after the transfer, the item is used by John Limited as plant, which means you need to adjust the carrying amount of the plant, not inventory. Okay. So your consolidation worksheet entries involve the elimination of sales revenue, because the seller sells inventory, right? So you have to eliminate the sales revenue. You also have to eliminate the cost of goods sold, because seller sells inventory that included in seller's record, there is a sales and cost of goods sold, which from the group perspective, these revenue expense do not exist. Okay. However, the buyer recognizes acquired item as a plant. Therefore, it is the carrying amount of the plant that is required to be adjusted in your consolidation worksheet. Because the selling price is 10,000 above the cost, right? Above the carrying of item. So that is the inventory cost of 40,000. The difference, 10,000, need to be adjusted accordingly. So we credit plant by 10,000. Okay, so good news, we get correct debit credit, right? So you use credit, that's very good. But it has to just be very careful whether there's any change in the classification of the transfer item. All right, now, up to here, we have covered the most difficult part of the intragroup transaction, okay? Now, the rest are very simple. Now, let's look at intragroup services, and then intragroup dividend, intragroup borrowings. Okay. Now, for all these intragroup transactions, there are no tax effect entries. So you might notice that the tax effect entry is only required when there is any unrealized profit loss resulting from the intragroup transfer inventory or PPE. Now, for intragroup services, we don't have any unrealized profit loss here, okay? So the elimination entry is still required. That is to eliminate any intragroup service revenue and service expenses. And it is very common, parent company providing some management services, IT services to their subsidiary and charge service fee. When revenue is earned, parent's company records service fee revenue, but subsidiary at the same time recognize service expenses. Now, if the payment is still outstanding and not settled by the reporting date, you also have to eliminate related payable receivable accounts. So this is one type of intragroup services. Now, the other one is related to intragroup renting. So for example, parent's company has spare warehouse and rent it to subsidiary and earn rent revenue, okay, from the lease contract. Now, when parent's company recognizes the lease revenue, the subsidiary record lease expenses. But again, these are the transactions between the entity in the same group. Therefore, need to be eliminated for consolidation purpose. So the related revenue, expenses, payable, receivable accounts are required to be removed in full on the consolidation worksheet. Now let's look at the following example. Now, assuming parent's company Jessica Limited provides services to subsidiary and charge 30,000 service fee. Now, the parent's company Jessica would record service revenue, right, on the credit side, and on the debit side recording receivable accounts. Well, Amelia at the same time will recognize service expense and raise a liability payable accounts. However, from the group viewpoint, those revenue expense do not exist, and therefore need to be eliminated. So on the consolidation worksheet, you have to prepare your adjusting entry to eliminate the service revenue, service expense in the record of parent subsidiary. Its effect in the worksheet, right? And we also have to eliminate any associated payable, receivable accounts directly related to this intragroup transaction. So you can see the overall impact of this elimination entry in the worksheet on the group profit is 0, right? So you can see there is no impact on the group overall profit from this intragroup elimination entry. That's the reason why no tax entry is required here. So you don't need to prepare any tax effect entry. No impact on the overall profit of the group. Then do you need to carry over this to the next year? Depends on. If the payment is still outstanding, yes, next year have continue to eliminate the payable receivable, right? But this one, no, right? All close to retained earnings, the impact on retained earnings is 0. Okay. Now let's look at the following MCQ. Now remember what I said earlier? No tax entries required, right? C. So anyone choose D? Hongren, Wang Hongren? Do you agree C or D? C. Okay, very confident. Thank you. Now C is correct, right? C is correct. So the elimination of the rent revenue require a debit adjustment. Debit means decrease, right? So you debit rent revenue, then credit rent expenses. Okay, so don't get confused with D. If you recall, if D, what happened? Oh, there's double counting, right? Rent expense, you're not eliminating, you record again in the worksheet. That does not make sense. Okay. So we choose C. Very good. Now then, move on to the next. We're going to look at intragroup dividend. Now, first of all, we have to identify what is intragroup dividend. If the dividend is paid by subsidiary and received by the company, parent company, recognized by the parent company as a dividend income. Now that is intragroup dividend, right? But what if the parent company paid or declared dividend? Is that intragroup dividend? No. But of course, here we make assumption. Subsidiary entity not holding any shares in the parents. Don't make this complicated, okay? So when parents declare or pay dividend, it is the shareholders of the parent, which is actually the outside party, right? Then this is now the intragroup dividend, okay? So pay attention, who paid dividend in the question. Okay? Now, the reason we have to eliminate the intragroup dividend is actually comply the same principles as we said earlier. It's intragroup income, so must be eliminated. And another very important reason is to avoid double count the profit of subsidiary. Now let's look at the following example. Okay? Now assuming parent owns 100% shares of subsidiary, which means the dividend declared or paid by subsidiary will all be recognized by the parents as a dividend income, right? Now, assuming subsidiary earns after-tax profit of 50,000 this year and paid all these amount as a dividend to the parent's company. So you can see parent's company therefore recognize a dividend income of 50,000. Assuming parents has no other income, okay? There's only one income. Now, do you need to pay tax for this 50,000 dividend income? No, because Australian adopt imputation tax system. Dividend is already from the after-tax profit distribution. You don't need to pay tax again, okay? The dividend is from the after-tax profit distribution from the subsidiary. So when parents recognize this dividend income, parents don't need to pay tax again because there are imputation credit attached to this dividend, as long as they're Australian resident or Australian company, okay? All right, now, so we know the profit reported by the parents is from the dividend distributed by subsidiary. If you do not eliminate this intragroup dividend, what happens? The parent's profit, 50,000, plus the profit earned by subsidiary, 50,000. Well, the group report 100,000, but that is double counting, right? Because all these 50s actually come from the profit earned by subsidiary. If you don't want to double count the subsidiary profit, it is necessary to eliminate the intragroup dividend of 50,000 recognized by the parent company. Okay. Now let's look at the entries in the record of the consolidation worksheet. Now you have two different types of the two different situations. The first dividend declared in the current year not paid. Now that is related to final dividend. So usually declared by the end of the reporting period, could be just a couple of days before the reporting period. Then this dividend then will be paid in the following financial year. You also have a dividend declared and paid in the same accounting period. Now that's related to the interim dividend declared and paid. Okay. Now let's look at two different examples. Now assuming on 25th of June 23, now Amelia is a subsidiary, right? Jessica is a parent. Amelia declares a dividend of 4,000. It is very close to reporting date. Reporting date is 30 June. And this dividend then will be paid, could be in sometime in August. Okay, that belong to the next financial year. Now the real entries in the record by legal entity includes Amelia recognized a payable. The once Amelia declared, raise a liability, okay, and debit dividend declared. Now some students ask, can I debit retained earnings? Well, technically is correct, but it's not the common practice. Okay? Now we usually have to raise a dividend declare accounts and then close this account to retained earnings later. Okay? So with debit dividend declare, this is equity account, but this account will be closed to retained earnings, and then we credit dividend payable. Now Jessica, as a parent's company holding 100% shares in Amelia, would recognize a dividend income of 4,000 and raise a receivable, dividend receivable 4,000. Now, from the group perspective, such transactions do not exist. So we simply just reverse the entry recorded by each legal entity in the worksheet. By debit dividend payable, credit dividend declared. That is reversing the entry recorded by Amelia, right? And then debit dividend revenue, credit dividend receivable. This is to reversing the entry recorded by Jessica. Right. But these are notional adjustments. So these are adjustments only in the worksheet. Now, can I have a different combination? Because for me, I say easy to remember if I have elimination of the intragroup dividend payable, correspondingly credit dividend receivable, right? And then debit dividend revenue, credit dividend declared. That's fine. Okay, so you have a different combination. That's okay. Just as long as your per line adjustment is correct here. Yeah. All right, now then moving on to the second situation, assuming the dividend declared and paid in the same accounting period. Now the entry recorded by Jessica, so you can see for interim dividend, you don't need to raise payable or receivable because the entry will be recorded by the time the cash dividend is paid or received. Okay. Now for Jessica, who received the cash dividend, recognizes as a dividend income when cash received, right? So debit cash, credit dividend revenue. Now for Amelia, pass the entries in his accounts when the payment of the cash dividend is made. There will be a debit interim dividend paid, credit cash. You can see debit cash, credit cash, even out. Okay, so all you need to eliminate in the worksheet, including a debit of dividend revenue against interim dividend paid. That's it. Okay. Now, once again, no tax effect entries required because in Australian, dividend is tax-free. All right, now let's look at the following MCQ question. Xingchen, hello. I sent you an email. Okay, so that is Xingchen. Now you're assigned in Lansing School. Okay, so she sent you email several. You didn't get response. So please contact your group mates for your assignment, okay? Thank you. So let me know your answer, Xingchen, when you're ready, okay? 预赔 one 预赔 魏雨婷雨婷 汪玉瑶玉瑶 薛明 Yan Chen, what do you think? Which one is right? Xingchen, do you get the answer? Cash is definitely not involved, right? As you can see, parents recognize payable, subsidiary recognize, so parents recognize receivable, subsidiary recognize payable. So it's related to final dividend. So definitely not involve any cash. And even for intro dividend, debit cash, credit cash, recalled by each legal entity is even out. So A, B definitely wrong. Then choose between C and D. I narrowed down that to 50%. C, that's a C, right? The why is a C? Well, dividend declared retained earnings, they are basically same, right? So dividend declared as a temporary accounts eventually close to retained earnings. So we need to adjust dividend declared. So there will be a debit dividend revenue, credit dividend declared. Now, of course, you also need to eliminate debit dividend payable, credit dividend receivable. Right? Now, finally, let's have a look at intragroup borrowings. Okay. Yes.
In the start of our class, we talk about dividend except. What is
Dividend what?
except in the start of class?
Dividend is not an expense. Dividend expense, that is what you're saying. Dividend is not expense. Definitely not. 100% not. So dividend is an after-tax profit distribution.
I mean the second pages of our slides.
Oh.
We talk about the exception is the dividend declared by the substitute.
Oh, that is about the intragroup elimination of the dividend. So its elimination is relies on the parent's ownership interest. But for all the other type of intragroup transaction, parent's ownership interest is regardless, okay? So you don't worry about parents. It doesn't matter, it's 100% interest in subsidiary, 90%, 80%, you have the same elimination entries. But when it comes to dividend, here the parents is 100% interest. But if it's down to 90%, then it is 90% multiplied by the dividend declared or paid by subsidiary will be recorded as an intragroup, will be considered as an intragroup dividend. So the calculation of intragroup dividend relies on the parent's ownership interest in subsidiary. But for all the other intragroup transactions, the parent's ownership interest in subsidiary does not matter. That's what this means, okay? Any other question? Let me know, okay? So asking questions is always welcome in the class. Okay.
The parent company pay dividend to subsidiary.
Why parents company pay dividend to subsidiary?
Because we talk about sometimes the company, parent company issue shares.
That's a very good point, but I already made assumption. subsidiary that's not holding shares in parents, okay? So to make it easy. Now, of course, if the subsidiary entity, but be careful, the parents is not issue shares to subsidiary entity. The parents issue shares to the formal shareholders of the subsidiary. That's different thing, right? So when you are the shareholders of entity B, and I will buy your company, right? I can issue my own shares, but not to your companies, to you. You are the seller. The companies is the business I acquired. Make sense? Okay? All right, now don't get confused, but of course there are some shareholding between the entities that's possible. So that's why I made assumption. The parents, the subsidiary entity, does not holding any shares in the parent, okay? All right, now let's look at the integral borrowings. Now, so you can see it's very common members, right, in the group lending, borrowing money to each other, okay, and charging interest. Now, on the consolidation worksheet, it's necessary to eliminate all the intragroup borrowings, right? Like, for example, payable, receivable, including loan payable, loan receivable, debenture payable, investment in debenture. But we don't have debenture receivable, be careful, okay? So if you purchasing the debenture from other company, let's say you buy debenture from company ABC, like you recognize these financial assets, like debentures in ABC, right? That is your assets, or you can record as an investment in ABC, that's fine. Now we also have an advance from, advance to. Now which one is the asset, which one is the liability? Advance from is a liability, right? Advance to is an asset. Right? So advance to means you lending money to someone, right? Sorry? What? I didn't get. Oh, advance. The same, similar. Okay, it's similar things. Now then we have intragroup borrowings. Then you have intragroup payable, receivable, interest, expense, revenue. All need to be eliminated. But once again, no tax effects. Okay, so there's no unrealized profit from the intragroup borrowings transaction. Now let's give an example. So look at this example here. We have Jessica, the parent's company, issued 1,000 debenture, face value 100 each. Okay, there is a 15% interest attached to that debenture, and interest is payable on 1st January each year. Now Amelia is a wholly owned subsidiary of Jessica, acquired half the debenture issued. Now before we move on to look at the worksheet entries, now let's look at the entries recorded by each legal entity. Now Jessica, as the issuer, record the issue of debenture by debit cash because they are raising the cash, right, through issuing of the debenture, and then create a liability accounts. We can name these as debenture payable for 100,000. Now this is based on the 1,000 debenture issued multiplied by $100 each. Okay. Now this is the entry on 1st January when the debenture were issued by Jessica. Now then on 30 June 22, that is our reporting date, we are going to recognize the interest accrued. So how do you know the interest accrued not paid? Because the interest is paid. It is payable, right, on 1st January each year. And your reporting date is on 30 June. So there's half-year interest expense that is accrued by the company, and therefore need to be recognized. So with debit interest expense, credit interest payable. Now how to calculate the amount of interest here? The value of debenture, right, 100,000 multiplied by interest rate 15%. How many months? Or say how many years? Half a year. That's why you need to multiply 0.5. Okay. So always pay attention to the date. Okay. Now then move on to look at Amelia's record. Now remember, Amelia acquired half of the debenture issued by Jessica, and it is this half represent the intragroup borrowings, right? So Amelia on 1st January 22 recognized an asset, which is investment in Jessica, or debentures in Jessica. That is a financial asset to Amelia. Okay, and then credit cash, only half, that is 50,000. Okay. And on 30 June, Amelia recognized the interest revenue earned by holding the debenture in Jessica for half a year, right? So we should recognize half-year interest revenue, which is accrued. On the debit side, we record interest receivable. And on the credit side, recognize the interest revenue. Now, it is this interest related to intragroup interest. So you can see the intragroup elimination is actually based on the amount of the debenture and interest recorded by Amelia. Now, based on this analysis, now we go back to our slides. You can see the elimination entries involve the elimination of intragroup debenture payable, right? Based on the amount acquired by Amelia, that is 50,000. And we also need to eliminate the intragroup asset debentures in Jessica recorded in Amelia's accounts. In addition to that, the intragroup interest payable, interest receivable, intragroup interest revenue, interest expense should all be eliminated in full in your consolidation worksheet. The impact of these adjustments on the group profit is zero. So there's no unrealized profit and loss from this intragroup borrowing transaction. We don't need tax effect entry. All right, okay. Now, so have a look at the next exercise. Zimu, Yang Zimu. 天池 青阳，张青阳，青阳，若琪，易伟，张易伟，郑中旭。What do you think? The last one, do you agree? The last one, he said the last one is right. Do you agree? This is right, right? This is correct. Okay, so why is D? That's correct. The elimination of the intragroup revenue and expenses, right? If you say no adjustment, now you need adjustment because their incurred of intragroup interest of 20,000 need to be eliminated. Okay? So in addition to the advance from, advance to accounts, we also need to eliminate the intragroup interest. Okay? So including a debit of interest revenue and a credit of interest expense. So B is definitely wrong. The debit credit is wrong, right? And if you look at C, there's no adjustment of retained earnings. So adjustments related to the current year revenue expenses. And this does not need to be carried over to the following year, or nothing need to be carried over from the last year as well. All right, now, so next week, we're going to focus on NCI. So the group under discussion at this stage is still wholly owned subsidiary, but in the next week's seminar, we are going to have a look at the non-controlling interest and how we're going to measure and record the NCI entries in the worksheet. Now, finally, let's have a look at our in-class question in relation to this topic. Now, let's look at question 1 first. Now, this is the current year integral sale of the inventory. Okay, Now, why we know it's a current year, or the first is a current year, the second is not, the second is prior year. Now, if you look at the worksheet entries required to be prepared here, it's on 30 June year X-ray. Now, the first intragroup transaction took place in the current year because it's during year X-ray, right? Subsidiary sold inventory parents for 500,000, that is intragroup transferring price. The original cost is 300,000. Now, 1/4 of the stock is still on hand at 30 June X-ray. Let's use four-step method. What is first step? Eliminate all the intragroup sales revenue in full, right? So how to record that? Xiuyun? Yes, Xiuyun, that's you, right? So what is your first line adjustment in the worksheet? You debit intragroup sales revenue, right? So we need to debit the intragroup sales. The intragroup sales revenue here is 500,000. When subsidiary sold inventory to parents, there will be a sales revenue of 500,000 recognized by the subsidiary. However, from group viewpoint, this sales revenue doesn't exist, right? Should be eliminated in the worksheet. So our first step is always to eliminate all the intragroup sales revenue in full. So you debit sales revenue, 500,000. And then the second step, adjusting the carrying amount of inventory on hand. And your adjustment is based on the unrealized profit contained in closing balance of the inventory. So what is that? What is a credit adjustment? Credit inventory for the amount of 200,000. Are you sure? Are all these inventories still on hand, or only part of these inventories still on hand? If all the inventories still on hand, you're right, 200,000. That's correct. 25% multiplied by 200,000. Okay, so your adjustment is based on the percentage of inventory that is still on hand. That is 25% multiplied by 200,000. Right. And the balancing figure, we make adjustment to cost of sale. Okay. Now, based on this analysis, I think we can work out the worksheet adjusting entry. Now, you can combine these two entries if you want to, okay? And in the exam question, I will only give you 3 lines. So there will be a debit sales revenue, 500,000, credit inventory, 50,000. Where I get 50,000 is by using 200,000 profit from the intragroup sale, right? Multiplied by the percentage of inventory still on hand, 25%, that is 50,000, okay? Now, once we find out debit sales 500,000, credit inventory 50,000, the balancing figure, we adjust to cost of sale, which is 450,000 on the debit, on the credit side, right? On the credit side. Anything else? Tax, don't forget tax, okay? So you can see profit of 50,000 is eliminated. So profit decrease, tax decrease. So our income tax expense should reduce by 15,000. And on the debit side, we recognize DTA. So DTA is recognized because your carrying amount adjustment of the inventory, right, is down by 50,000, create deductible temporary differences. Now, so this is our worksheet adjusting entry for the current year intragroup transferred inventory. All right, now let's moving back to our question. We got another one. In the opening inventory of subsidiary limited for year 20X2, now that is the last year, right? There was an amount of 80,000 being profit earned by parents company on the sale of inventory. So you can see we have 80,000, that is before tax, okay, from the prior year intragroup transferred inventory from parents to subsidiary. It doesn't matter, parents to subsidiary or subsidiary parents. So all we need to find out is the total unrealized intragroup profit, right, from the last year. And this unrealized profit will be contained, right, in the opening retained earnings of the current period. Therefore, you need to adjust opening retained earnings of the current period for 80,000, that is before tax once again. Okay? And when these inventory were sold in the current year, adjustment made to cost of sale. Now that is our reasonable assumption because inventory as a current asset, its opening of the inventory are expected to be sold by the end of the financial year. Okay? Now then also have to consider the tax, right? So once the cost of goods sold is adjusted down by 80,000, the income tax of the group will increase by 30% of 80,000. Now, what about the credit retained earnings? So this is related to prior year ITE adjustment. Right? So you can just combine these with the debit retained earnings 80,000 to get after tax unrealized profit. We eliminate that in the opening retained earnings, which is 56, right? So 80,000 times 70%, which is 56. Yeah. So combining together, you have a debit retained earnings 56,000, debit ITE 24,000, and a credit cost of sale 80,000. So these two entries, sorry, I didn't put that in the same. I just can't change it because it doesn't allow me to do any editing. Here we go. So you can these two entries, so just combine them. Okay, just combine them as a single one. So let me know if there's any question from this part. All good? Okay. Now then moving on to have a look at the second question that is related to intra-group transfer of PPE. Okay. Now, worksheet entries are required for year end 30 June X1, X2, and X3. Now, assuming you are currently in year X1, okay? Now, let's have a look at when these intergroup transactions take place. Now, it's on 1st July year X0, which is the beginning of year X1, right? That is the beginning of the year X1. So if you are in year X1, it is related to current year transaction. Now, parent company sold equipment with a carrying value of 1 million to subsidiary for 1.5 million. Intergroup selling price 1.5 million. The carrying item sold is 1 million, which means the parent company can recognize a 500,000 gains on sale, right? So think about what is the parent's record of these transactions. So parents debit cash, right?
Credit sales revenue.
So parents debit a cash of 1.5 million, right? Debit cash one, because that is the sales proceeds received from the transaction. And then parents need to de-recognize the equipments from its balance sheet. So there will be a debit of accumulated depreciation and credit equipments, right? Now give me the number. The arranged cost equipment is 1.4 million. So here is 1.4 million, and accumulated depreciation is equal to. The accumulated depreciation is 400,000, right? So 400,000. Okay. Now then we should have another credit line of gains on sale. Very good. So the gains on sale in the record of the parents, that is equal to 500,000. Now for consolidation purpose, now these gains on sale in the record of parents remains unrealized, right? And therefore need to be eliminated. And from the group viewpoint, this is unrealized gains and must be eliminated. Okay. Now what about subsidiaries record? A subsidiary recognizes equipment 1.5 and pay cash 1.5 million. That's very easy. Yeah. But we need to find out the worksheet adjustment. Okay. Now you can see subsidiaries recall of the equipments, right? Now this is the cost. Okay, and that is accumulated depreciation. So you can see subsidiary recall immediately after transfer is 1.5 million, right? Is 1.5. Now what is group position? The group position, the group cost is 1.4 million, right? Because the group position is a parent's position immediately before the sale for this item, right? Immediately. So you can see this item cost, original cost is 1.4. Therefore, it is also the original cost to the group. Okay. So you can see this difference represent your adjustment. You need to adjust the cost of equipment down by 100,000, right? Because it is overstated by subsidiary after transfer. Right? The accumulated depreciation immediately after transfer is 0, but the group position you should have accumulated depreciation balance of 400,000. Therefore, in the consolidation worksheet, the accumulated depreciation balance should be credited, right? Should be reinstated by 400,000. Now, based on this analysis, let's prepare our worksheet entries on 30 June year X1. Okay, so you can see year X1, including elimination of intra-group gains on sale, that is 500,000. We also need to adjust the carrying amount of the items sold. So the carrying amount of the equipments, right, should be adjusted based on the difference, right, between what is recorded by legal entity compared with what should be reported by the group. So you can see the equipment cost should be reduced by 100,000. And the accumulated depreciation balance should be reinstated by 400,000. So you can see these two line adjustment effectively reduce the carry amount equipment by 500,000. Okay. Then we show tax effect of the adjustment. No gains, no tax. The income tax expense then should be reduced by 150,000, right? The income tax expense reduced by 150,000, and the DTA should be recognized or raised by 150,000 because the equipment's carry amount lower than tax base by 500,000 after these adjustments. Now, this resulting a deferred tax recognition of 150,000, that is 30% of 500,000. Okay. Anything else? Is that all for our worksheet entries on year X1? Depreciation. Now, always remember, if a PPE, you always have to ask yourself, do I need to adjust for the depreciation? Okay. Now, there is a depreciation adjustment for 1 year because the transaction took place at the beginning of the current period. Okay. Now, let's look at the depreciation adjustment here. Now, so if we go back to the question, you will find that the remaining useful life is 5 years. The depreciation expense in the record of the subsidiary is equal to 1.5 million divided by 5 years, right? However, from the group viewpoint, the remaining depreciation amount since the transfer is 1 million divided by 5 years. Now, we can just take the difference between 1.5 million with 1 million, that is 500,000. That's represent the total difference, right? Then divided by 5 years, each year adjustment of depreciation would be 100,000. Okay? So once we get this, let's have a look at our entries. Okay? So we debit accumulated depreciation and the credit depreciation expense is overstated. The depreciation expense is overstated in the legal entities record. And that's the reason why we need to reduce the amount by 100,000 in the worksheet. And in addition to this, don't forget tax. Okay? Depreciation expense increase resulting the group profit, depreciation expense decrease, right? Resulting group profit increase, therefore, increase the income tax expense. So adjustment is based on the depreciation adjustment of 100,000 multiplied by 30% tax rate. Okay? And then we're going to show a reversal of the DTA for 30,000. Now, this is your year 20, year 20 X1 entry. Now, think about year X2. So you can say all the year X1 worksheet entries in relation to this item, right, need to be carried over to the following year worksheet. Because all these entries, they are notional adjustment, have no real impact on the parent subsidiary's own record. Okay. Now let's have a look at the year X2 entries now. So prior year elimination of the gains on sale close to retained earnings, right? Prior income tax expense also close to retained earnings. So you can see the debit of retained earnings, 350,000, represent the after-tax unrealized gains resulting from prior year intragroup transfer PPE. So simply 500,000 multiplied by 70%. And the prior year recognition of DTA, well, we just need to repeat that line, okay? And the prior year adjustment of the equipment cost, accumulated depreciation, reinstate the accumulated depreciation balance 400,000. Again, just copy down that. Okay. Now, in addition to this, we are going to carry over prior year depreciation adjustment to the current period. So that's why you have a credit retained earnings of 100,000. And we need to record current year depreciation adjustment in the current year worksheet. Right? So current year plus prior year depreciation adjustment, the total accumulated depreciation adjustment that should be reflected in the current year worksheet will be 200,000, represent 2 years of adjustment. What else? What else? After this, tax, right? So tax again. So your current year depreciation expense adjustment resulting a current year group profit increase by 100,000. Therefore, increase the current year income tax expense. The prior year depreciation adjustment resulting prior year IT adjustment, right? And these adjustments we need to carry over its effect to the current period by debit retained earnings. So these debit retained earnings, 30,000, represent prior year ITE adjustment contained in the prior year worksheet. Okay. Now, then we show a reverse of DTA. For 1 year, 30,000, 2 years, that will be 60,000. Now, following the same rules, principles, same logic, right? We can do year X3. So think about year X3 entries. The first entry is same as year X2, right? There will be a debit retained earnings. If you look at year X3, so the first entry is same as before. Debit retained earnings, debit DTA, right? Adjusting the current amount of equipments. So this part, you just repeat that again. Okay. In addition to this, we are going to adjust depreciation, right? We adjust depreciation, okay? Now, year X3 depreciation adjustment also 100,000 because it's straight line methods, right? Straight line methods. So each year your adjustment depreciation will be same for over 5 years. Now, then we carry over prior 2 years, year X1 and year X2 depreciation adjustment to the current year. We credit retained earnings. Your accumulated depreciation adjustment reflect 3 years of your adjustment. That is from year X1 up to year X3. Finally, tax, okay? So current year depreciation adjustment resulting current year IT adjustment on the debit of 30,000 prior 2 years. The prior 2 years IT adjustment, we can just use 30% of prior 2 years depreciation adjustment to get this number. And the reverse of DTA, 3 years. So each year 30,000, 3 years 90,000. Okay. Now these also available on Moodle, so I will make this visible to everyone. Okay. But if you want to take a picture, feel free to do that. It's okay. But it's available on Moodle. Okay, so I will just keep that visible to everyone. Okay, so after the class. All right, guys. So let me know if there's